There's positive news for many homeowners tonight. The official cash rate has been cut to 3%, the lowest in 3 years, and it looks like there will be more to come. The Reserve Bank has signalled 2 further reductions to the benchmark lending rate this year, noting that the economic recovery stalled in the second quarter. Here's political correspondent Zane Small.
Angela Fahey purchased this Auckland new build in 2023.
So back then, this was $880,000, and the interest rate back then was 6.62%.
2 years later, and her interest rate is now 4.1%.
Incredible, absolutely incredible. I mean, it's a little bit life-changing.
She credits the help of her mortgage broker, Hamish Patel.
We've split the loans across 2 banks this time, not just one.
For her, in terms of the interest rate journey, obviously there's a bit of reprieve. She's been paying a much higher rate, I guess, and like most New Zealanders.
And there appears to be more interest rate relief on the way, with the Reserve Bank today announcing a cut to the benchmark lending rate, bringing it to 3%, the lowest in 3 years.
Where there was a strong consensus was around the central path for the official cash rate. There was comfort that that could be lowered.
The cash rate's been on quite the journey, thanks to a recession engineered by the Reserve Bank itself to cool down post-pandemic inflation. The rate was hiked up 12 times in a row and then kept at 5.5% for more than a year, eating into the spending power of homeowners. In August last year, a series of 6 cuts began as the central bank changed tack and tried to stimulate growth. That came to an end last month after inflation started ticking up again. It was kept at 3.25%. But today, another cut to 3%.
It's a fine line that the Reserve Bank is tracking along.
A fine line because the Reserve Bank is tasked with keeping inflation under control. And yet it's been rising, particularly food prices. But the central bank says the economic recovery stalled in the second quarter of this year.
Have you noticed that there has been a significant change in the behaviour of households and businesses and their spending habits?
There has been this cautiousness in businesses and consumers, and it has lingered longer than we had anticipated. And so that's some of the thinking around whether those sectors have just become too cautious and need a bit more of a lift.
Obviously, anything that I'm probably saving, I'm shifting across to rates and, insurances, that kind of thing. So it's not easy.
Unemployment has been rising, and today Fletcher Building reported a $400 million full-year loss.
But one of the key things that we also need to consider is that the 250 basis point cuts that we've now done, we've probably seen 50% of that transmit through. So there's another 50% still to go. So there's certainly more stimulation still to come.
No doubt the last 3 months are a very difficult time in terms of growth for New Zealand and around the world, thanks to the trade tariffs environment, where there's been a loss of confidence and sentiment. This is really welcome stimulation.
I think there's a lot of people out there doing it extremely hard. I truly do. But I think that we're in a situation where that's going to turn around. People have just got to hang in there.
A glimmer of light starting to shine through the economic gloom.
So, Zane, some positive signs today. Could this play well for the government heading into the election?
Well, certainly the projections are looking better. GDP growth is expected to increase over the coming year as homeowners roll on to those lower interest rates. But remember, we're coming from a very low point, and Infometrics has just released an analysis suggesting that the Reserve Bank may have been a bit spooked by the state of things, especially considering that 2 members of the Reserve Bank's Monetary Policy Committee wanted to cut the official cash rate by even more than it was today. It's now expected that there will be 2 further cuts in October and November, which would bring the benchmark rate to 2.5%, which is considered to be lower than neutral. That will depend on inflation. It is expected to rise a bit more and reach 3% in the next quarter, reflecting the higher cost of food and those rates rises. But inflation is then expected to ease to 2% by the middle of next year, which would be just in time for the election. However, that is just an estimate.
OK, Zane, thanks so much.